When you think of Moody's, what's the very first image that pops into your head? Be totally honest. Is it like a dusty room full of people in pinstripe suits looking at spreadsheets? Maybe a stern schoolmaster giving a corporation a B- on its homework?
That is the classic archetype, isn't it? The impartial umpire, the boring but necessary plumbing of the global financial system. And for about 100 years, that's pretty much what they've been.
Exactly. And boring plumbing isn't usually something we rush to the microphone to talk about. But we're looking at the Q4 2025 earnings report for Moody's Corporation, which just dropped today, February 18th, 2026. And let me tell you, if you still think of them as just the boring bond people, you are missing one of the wildest pivots in the modern economy.
It really is a transformation. I mean, if you read between the lines of this report and what the CEO said on the call, Moody's has basically repositioned itself. They're arguing they aren't just a ratings agency anymore. They are now, and this is their term, the trusted context layer for the entire AI revolution.
Trusted context layer.
Hmm.
Okay, that sounds a little like marketing speak, but we're going to unpack what it actually means. Because we're talking about a company that just had its busiest fourth quarter in history. They're rating the massive mountains of debt that are literally building the AI world, and at the same time, they're using their own AI to help catch criminals and automate banking.
It's a dual engine story. You've got the legacy business, the ratings, and this futuristic business, the analytics. And for maybe the first time, both of those engines are firing at maximum capacity at the same time.
So our mission for this deep dive is to figure out how the plumbing of the financial system became, well, a stealth AI growth stock. We got the earnings report, we've got the conference call transcript, and a whole lot of numbers to get through.
And the numbers tell a very, very specific story about where all this is heading.
Let's start with the scoreboard. The headline numbers for 2025 are huge. A record year. Revenue over $7.7 billion. That's up 9%. But the number that really jumped out at me was the profitability. Their adjusted earnings per share EPS up 20% to $14.94.
Which is significant. You have to contextualize that. I mean, 20% earnings growth for a massive, mature company like Moody's is, it's aggressive.
Yeah.
That is not utility stock behavior. That is a growth stock.
Right. If a startup grows 20%, you shrug. If a century-old institution does it, you really pay attention.
Exactly. And if you zoom out even more, that's about 70% earnings growth over just the past 3 years. That's a compound annual growth rate of around 20% since 2022. They are just compounding value way faster than the broader market.
So why the explosion? Is it just the economy doing well, or is there something specific happening here?
Oh, it is absolutely specific. It's the AI boom, but it's the part of the boom we don't usually talk about. We're always focused on the chips, NVIDIA, AMD, or the software like OpenAI and Microsoft. We rarely talk about the sheer ocean of capital you need to actually buy those chips and run that software.
The money behind the tech.
Precisely. In 2025, Moody's rated $6.6 trillion of debt. That is an all-time high. And the driver was this perfect storm, the issuance cycle, companies selling bonds, and the investment cycle, companies needing cash to build. They just collided.
I saw a stat in the report that blew my mind. In Q4 alone, they rated $70 billion in issuance just for the tech giants. So they were talking Alphabet, Amazon, Meta.
Right. And you have to ask yourself, why are they borrowing? I mean, these companies have billions in cash on hand.
That's always my question. If Amazon has a vault full of gold, why does it need a loan?
Because the scale of this AI build-out is just unprecedented. It's an arms race to build data centers. You need energy infrastructure, cooling systems, endless racks of GPUs. That costs hundreds of billions. Even for them, it makes more sense to borrow that money than to just burn through their own cash.
So when Amazon or Meta decides, hey, we need to buy 10,000 more GPUs, they have to knock on Moody's door first.
They do. They need that AAA or AA rating to sell that debt to investors. Moody's is the gatekeeper.
I like that. It's like a toll booth. Moody's is sitting on the highway to the AI future, and they don't really care which car wins the race. ChatGPT, Gemini, whatever. They just care that the road is full of traffic.
That's a perfect analogy, and the traffic is heavy. But it wasn't just the public tech giants. The report pointed to a massive spike in private credit.
Oh, yeah. That stood out. Private credit revenue grew nearly 60% in 2025. I should probably pause on that. We hear private credit thrown around a lot. How's that different from just going to a bank?
It's a huge shift. So traditionally, a mid-sized company would go to a big bank or the bond market. But after the banking crisis a few years back, and with all the new regulations, banks just pulled back. They stopped making as many risky or complex loans.
And in stepped the so-called shadow banks.
Well, we call them asset managers now, but yes, firms like Blackstone, Apollo, KKR, they stepped in to lend that money directly. That's private credit. It's a massive, massive market, and Moody's has managed to insert itself right in the middle of it.
How'd they do that?
The report mentions Moody's was the sole rating agency on the largest private credit CLO of the year.
Okay, another acronym alert. CLO.
Collateralized loan obligation. Just think of it as a bundle. You take a whole bunch of those private loans, you package them together, and you sell slices of that package to investors. It spreads the risk out. This one was a $1.5 billion deal from Blackstone.
So they're rating the bundles of private loans just like they rate the bonds from public companies.
Exactly. Public-private, doesn't matter. If big money is moving, Moody's is taking a cut. So that's the rating side of the house. That's the cash cow.
But there is always a but.
The real growth story, the AI story, isn't just about rating debt. It's on the other side of the business, Moody's Analytics.
This is where we get into that phrase you mentioned, the trusted context layer. Because historically, analytics for Moody's was just, selling data feeds to terminals? A subscription business.
It was, but the whole value proposition has shifted because of generative AI, and this is the core of their pitch. They've coined this term, decision-grade contextual intelligence.
Okay, let's unpack decision grade. That implies there's a lot of non-decision grade info out there.
Well, think about it. Generative AI can create content instantly. It can write code, poems, summaries, but as we all know, it hallucinates. It just makes stuff up.
Oh, absolutely. I asked an AI to write a bio for me once, and it claimed I'd won a Nobel Prize. I mean, I wish, but it was a complete lie.
Exactly. Now imagine you're a bank deciding on a billion-dollar loan, or a government agency trying to track terrorist financing. You cannot rely on a probabilistic guess from a chatbot. If the AI hallucinates a credit score or a criminal record, the consequences are just catastrophic.
You can't take a hallucination to court.
You cannot. You need ground truth. Verified, auditable data. So Moody's is basically saying, go ahead, use your amazing AI models, but if you want them to be useful for anything that matters, you have to feed them our data.
So they're selling the guardrails.
They're selling the foundation, and people are buying it. In Q4, recurring revenue was 97% of Moody's Analytics revenue. These aren't one-off purchases. This stuff is being hardwired into the daily workflow of these huge institutions.
But let's talk about what that looks like in practice. The call transcript had some examples that were, honestly, kind of wild. There was a mention of a Tier 1 U.S. bank using Moody's agents.
Yes, this is where we see AI moving from just hype to actual ROI. This bank is using Moody's agentic solutions, so think autonomous AI bots, to automate drafting credit memos.
Credit memos. It sounds boring, but that's the lifeblood of a bank, isn't it?
It is. It's the detailed report a banker writes to justify a loan. They pull the balance sheet, analyze cash flow, check risks, write it all up. It's tedious, data-heavy work. This bank is now generating 35% to 40% of that memo automatically.
And the time savings.
They estimate it's saving their analysts hundreds of thousands of hours.
Hundreds of thousands of hours. That is, honestly, that's almost scary.
It is. And it's not just in the U.S. They talked about banks in Asia-Pacific and the Middle East cutting decision times by 80% and reducing loan processing cycles by 15 times.
Wait, 15 times? So a loan that used to take 2 weeks now might take, less than a day?
That's the implication. And this is driven by products like Credit Lens, their main lending solution, which is growing at almost 20% year over year.
Makes you wonder what all those junior analysts are going to do with their free time.
Right.
Or if they'll even have jobs. But that's a whole other deep dive.
It is, but efficiency is just one part of it. There's a story in the call about Interpol that honestly felt like it was out of a spy movie.
This was my highlight. It really shows what decision grade means. Interpol used Moody's ownership and firmographic data to target illicit finance. Firmographic, so that's just demographics, but for firms, right? Who owns what?
Exactly. But in the world of money laundering, that is incredibly complicated. Bad actors hide behind shell companies inside other shell companies in different countries. It's a maze.
So Interpol used Moody's to solve the maze.
Yes. Moody's has this database called Orbis that tracks hundreds of millions of private companies. So Interpol used that data to, pierce the veil of these shell companies. The operation led to 83 arrests in 6 countries.
See, that's where the hallucination problem comes back. You can't ask ChatGPT who secretly owns this shell company in the Cayman Islands. It doesn't know. It can't know.
And even if it guessed, you can't get an arrest warrant based on a guess. You need court-admissible, auditable data. That's what they mean by trusted context, and that's why people are paying a premium for it.
There was another example of a massive e-commerce tech company, they didn't name them, but it's a short list, using Moody's to screen 15,000 suppliers.
This is the KYC, or Know Your Customer space, or in this case, Know Your Supplier. That partnership has grown 20-fold in just 3 years.
20-fold? That's insane.
Yeah. If you're a global giant, you're responsible for your supply chain. You have to know if your supplier in Vietnam or Brazil is on a sanctions list or owned by a politically exposed person. Moody's automates all that screening.
It feels like Moody's has built this massive moat around their data. But I have to play devil's advocate here. This is the dumb question they always ask. If AI models are so smart, why can't a startup just scrape the web and replace Moody's? Why can't the next GPT just do this for free?
That is the multi-billion-dollar question. And the CEO, Rob Fauber, he actually tackled this head-on in the call. He laid out what you could call the moat defense.
Okay, walk me through it. Why can't I just Google this stuff?
Well, the first line of defense is just access. A huge chunk of their data is not on the open web. It's locked behind commercial agreements, IP rights, physical archives they've digitized. You can't scrape what isn't public.
Okay, fair point. But what about the public stuff? Financial reports, filings.
That brings us to the second defense. Semantic complexity.
Fancy words. Translate for us.
It just means that revenue in France is calculated differently than revenue in Japan, or net income has different local standards.
Yeah.
If you just dump all that raw data into an AI, it gets confused. It compares apples to oranges. Moody's has spent decades normalizing that data, cleaning it up so that an apple in Tokyo looks exactly like an apple in New York.
So they're the data janitors of the financial world.
They are, but the third defense is maybe the hardest problem in data science. Entity resolution.
Entity resolution.
The problem of names. Let's say you have a record for John Smith, Inc., one for J. Smith, LLC, and another for John Smith & Sons. Are they the same company? Are they related or totally different?
Right. And if you get that wrong on a credit report, you get sued. If you get it wrong for Interpol, you arrest the wrong person.
Exactly. Moody's has proprietary logic and actual human teams that have been untangling these knots for years. An AI model needs that ground truth to function. So Moody's isn't competing with AI. They're selling the map that the AI needs to navigate reality.
That makes a lot of sense. They're the cartographers. And the map keeps getting bigger. They aren't just looking at financial data anymore. The Q4 report has some fascinating new frontiers. Yeah, I saw a heading for severe convective storms. Sounds like a heavy metal band, but I'm guessing it's about insurance.
It is. Climate risk is becoming a financial risk. They launched a new model calibrated on $55 billion of granular claims data.
Wait, $55 billion in claims data. Where do they get that?
From the insurers themselves. It's a data consortium. This data exists nowhere else on Earth. They are modeling what they call secondary perils.
Secondary peril.
Everyone models hurricanes, those are primary perils. But these convective storms, so think severe thunderstorms, hail, tornadoes, they are starting to cause damage that rivals hurricanes because of climate change. Insurers are desperate for this data to price their policies correctly. If they get it wrong, they go bankrupt. Moody's is selling them the math to survive.
And then, shifting from weather to the digital world, they talked about crypto, specifically stablecoins.
This is a bold forecast. Moody's expects the stablecoin market to hit $2 trillion by 2028.
That is a lot of digital cash.
It is. And Moody's wants to rate it. They just released a methodology for rating stablecoins. They want to be the ones who tell you, yes, this digital dollar is actually backed by a real dollar. It's a move to legitimize the crypto space, kind of like they did for the bond market a century ago.
It's interesting to see them expanding, but I also saw they're cutting some things. They sold their learning solutions business.
Yes, strategic discipline. They sold that training business, and they're selling their regulatory reporting business. These were lower margins, slower growth areas. They're basically pruning the tree to focus everything on the high growth stuff. Lending, KYC, insurance, and ratings.
Getting lean for the AI race.
Exactly.
So to bring it all home, we've got record revenue, a debt ratings boom from AI infrastructure, and this big transformation in their analytics business. What's the outlook for 2026?
They're projecting high single-digit revenue growth. And interestingly, they expect debt issuance to be front-loaded.
Meaning everyone's going to borrow money in the first half of the year.
That's the expectation. Companies want to lock in that capital now while conditions are good. So we should see a very, very strong start to 2026 for Moody's.
It really feels like they are surfing a double wave here. On one side, they rate the debt that builds the AI. On the other, they sell the data that makes the AI useful.
It's a very rare position to be in. I mean, usually legacy companies get disrupted by new technology. Moody's seems to have found a way to become essential to the disruptors themselves.
Before we sign off, I want to go back to that stat about the bank saving hundreds of thousands of hours.
It really sticks with you, doesn't it?
It does. And here's the thought I want to leave our listeners with. If AI efficiency lets a bank cut loan processing by 15x and automated memos save millions in labor, who captures that value?
That is the big question.
Does the bank just pocket that profit? Do they lower fees for customers like you and me? Or does the data provider, Moody's in this case, capture that value by charging a huge premium for the fuel that makes it all possible?
CEO Rob Faber hinted at this. He mentioned they're trialing consumption-based pricing. So if you use their data to automate a $1 million task, they might want a slice of that $1 million, not just a flat subscription fee.
The toll booth operator might be hiking the prices. Something to think about as we watch this all unfold. That's it for this deep dive into the plumbing of the financial world. Thanks for listening.
Thanks, everyone.